By the end of 2025, the most powerful economic institution in the United States was no longer speaking with one voice. The Federal Reserve, an organization built on the appearance of calm precision, had spent the year quietly revealing how divided it had become. These were not dramatic arguments or public confrontations, but something more unsettling: persistent disagreement about how the economy truly looked beneath the surface and what should be done next. While markets searched for certainty, the people responsible for steering monetary policy were interpreting the same data in fundamentally different ways. At the heart of this divide was a simple but dangerous problem. The economy was sending mixed signals that refused to resolve into a clear story. Inflation, which had dominated headlines for years, was finally easing. Price growth was no longer accelerating the way it once had, and for many policymakers, this suggested that the long fight against inflation was nearing a turning point. Yet, just as inflation pressures appeared to cool, the labor market began to show subtle signs of strain. Hiring slowed, job openings declined, and wage growth softened. The economy was no longer overheating, but it wasn't clearly stable either. For the Federal Reserve, this ambiguity created a fault line. One group of policymakers saw the cooling inflation data as permission to act. From their perspective, holding interest rates too high for too long risked unnecessary damage to employment and economic momentum. They believed monetary policy had already done its job, and that continued restraint could push the economy toward a sharper slowdown than intended. In their view, the responsible move was to begin easing, carefully, gradually, but decisively. Another group saw the same data and reached a very different conclusion. To them, inflation was not yet fully defeated, it was merely subdued. History had taught them that premature rate cuts could undo years of progress in a matter of months. They worried that easing policy too soon would send the wrong signal, that the central bank was willing to tolerate inflation re-accelerating if growth showed any weakness. For these officials, credibility mattered as much as economic output. Once lost, it would be difficult to regain. These competing interpretations shaped every discussion inside the Federal Open Market Committee. Meetings became less about fine-tuning policy and more about how to define the moment the economy was in. Was this a soft landing unfolding naturally, or the early stages of a more serious slowdown? Were rate cuts a preventative measure or a dangerous gamble? The answers depended not just on data, but on philosophy, on how much risk each policymaker was willing to accept. As the year progressed, the Fed ultimately chose to cut interest rates, not once, but multiple times. Each decision, however, carried visible disagreement. Votes were no longer close to unanimous. Public statements began to reflect caution rather than confidence. Individual policymakers offered remarks that emphasized different priorities, different fears, and different interpretations of the same economic reality. For markets accustomed to clear guidance, this was deeply unsettling. Investors rely on the Federal Reserve not just for policy decisions, but for narrative control. When the Fed agrees internally, it shapes expectations smoothly. When it doesn't, uncertainty spreads. In 2025, that uncertainty became a defining feature of financial conditions. Markets reacted not only to what the Fed did, but to how divided it appeared while doing it. Every speech, projection, and press conference was dissected for signs of internal alignment, or the lack of it. By the final months of the year, it was clear that these divisions were not temporary. They weren't the result of a single data release or short-term shock. They reflected deeper disagreements about how the post-inflation economy should be managed and how cautious the central bank needed to remain. The decisions made in 2025 did not resolve those questions. Instead, they carried them forward, unresolved, into the future. The Federal Reserve entered 2026 still debating the same fundamental issue, whether the greater risk lay in doing too much or doing too little. And that unresolved tension would continue to shape every policy choice that followed.
As 2026 approached, the divisions inside the Federal Reserve hardened rather than faded. What had initially looked like temporary disagreement tied to unusual economic conditions began to resemble a structural split in how policymakers viewed risk itself. The debate was no longer just about interest rates, it was about the philosophy of central banking in a post-inflation world. The same economy was being interpreted through two very different lenses, and neither side was fully convinced by the other. One camp increasingly focused on the fragility beneath the surface. They pointed to slowing consumer demand, tighter credit conditions, and businesses becoming more cautious with investment. For them, the economy was not signaling strength, it was signaling resilience under pressure, and resilience does not last forever. They believed monetary policy worked with long and unpredictable lags, meaning the damage from past rate hikes might not yet be fully visible. Waiting too long to respond, in their view, risked turning a manageable slowdown into something far more painful. Opposing them were policymakers who saw a different danger. They believed the economy had proven more durable than expected, and that easing policy too aggressively could reignite behaviors the Fed had spent years trying to cool. Asset prices were already rising, financial conditions were loosening, and risk appetite was returning. To this group, those were warning signs. They argued that inflation's retreat was incomplete and that complacency could allow price pressures to return quietly, only to explode later. From their perspective, patience was not stubbornness, it was discipline. These philosophical differences influenced how policymakers communicated with the public. Statements that once sounded coordinated now felt fragmented. Some emphasized flexibility and responsiveness, while others stressed caution and restraint. Even when the Fed paused or adjusted policy in small increments, the reasoning behind those moves appeared inconsistent depending on who was speaking. The institution's traditional clarity, its ability to anchor expectations, began to weaken. Markets responded by becoming hypersensitive. Markets no longer reacted solely to policy decisions. They reacted to tone, phrasing, and even offhand remarks. A single sentence hinting at concern over employment could move markets in one direction, while a warning about inflation risk could reverse it days later. The Fed was still powerful, but its messaging was no longer singular, and that fractured signal increased volatility rather than calming it. Internally, the challenge became how to move forward without forcing consensus where it didn't exist. The Fed's strength had always been its credibility, built on the belief that decisions were grounded in careful analysis rather than ideology. But as debates dragged on, it became harder to disguise the fact that policymakers were making different assumptions about the future. Some expected inflation to stay contained, others expected it to return. Some believed the economy needed support, others believed it needed restraint. By early 2026, it was clear that monetary policy was entering a more uncertain era. The Fed was no longer navigating a clear crisis or a clear recovery. It was navigating ambiguity, and ambiguity is where disagreements thrive. The choices ahead would not be about dramatic shifts, but about small decisions with outsized consequences. And those decisions would be made by a committee still wrestling with the same unresolved questions that defined the year before. The economy had moved on from the inflation emergency, but the debate it created inside the Federal Reserve was far from over.
By the time 2026 was fully underway, the consequences of the Federal Reserve's internal divide were no longer confined to policy rooms or market commentary. They began shaping real economic behavior. Businesses delayed long-term decisions, unsure whether borrowing costs would continue to fall or stabilize at higher levels. Consumers, hearing mixed signals about the economy's direction, became more cautious.
Confidence didn't collapse, but it thinned quietly in ways that are difficult to measure yet powerful over time. For the Fed, this created a difficult paradox. The institution exists to reduce uncertainty, yet uncertainty had become an unavoidable byproduct of its own disagreements. Every data release now carried more weight than before because it had the potential to tip the internal balance of power. A stronger jobs report emboldened those urging restraint. A weaker inflation reading strengthened the case for further easing. Policy became increasingly reactive, not because the Fed lacked tools, but because it lacked alignment. This environment forced policymakers to confront an uncomfortable reality. The economy they were managing no longer behaved according to older playbooks. Inflation had cooled without a deep recession, challenging long-held assumptions. Employment remained relatively strong even as growth slowed, defying traditional signals. The old trade-offs between inflation and unemployment were less predictable, and that unpredictability made agreement harder, not easier. The deeper issue, however, was not technical, it was institutional. Central banks rely on trust that decisions are coherent, trust that strategy extends beyond the next meeting. When that trust weakens, policy loses some of its power. In 2025 and into 2026, the Federal Reserve was still respected, still influential, but no longer unquestioned. Markets learned to listen not just to what was said, but to who said it and why. Yet this period of division also revealed something important. The disagreements were not signs of dysfunction, they were signs of transition. The Fed was adjusting to a world where inflation shocks, global supply disruptions, and rapid financial shifts had permanently changed the landscape. There was no clear roadmap for this new environment, only competing judgments about how to navigate it safely. As 2026 continued, the Federal Reserve remained caught between caution and action, between fear of repeating past mistakes and fear of creating new ones. The divisions that defined 2025 did not disappear, they evolved. And in that evolution lay the future of U.S. monetary policy, not in bold declarations, but in careful, contested choices made under uncertainty. The era of easy consensus was over. What replaced it would define the next chapter of economic history.